1925 to 1974, the margin-volume differentiation equilibrium era.
Ford's single-minded commitment to cost reduction and volume production eventually became self-defeating, as the company discovered by the mid-1920s. As the automobile market approached saturation, by this time, nearly 70% of U.S. households owned an automobile. 26 prospects for stimulating further sales using price reductions alone began to dim. Moreover, industry margins had virtually evaporated, with Ford making as little as $2 per car in profit by 1924.27. Since automobiles were a durable good, it was also difficult to sell additional units to existing owners. As a result, the major automobile producers began resorting to mergers and to cultivating export markets in an attempt to preserve production volumes. For a short period of time, these measures allowed some U.S. car producers to survive in the face of a saturated domestic market and cutthroat pricing. The MVD era began in the mid-1920s as General Motors discovered that product differentiation and target marketing of multiple product lines not only generated higher margins but also expanded the market beyond the economy-minded buyer of basic transportation. 28 Moreover, it provided a means to compete with Ford on factors other than price. GM implemented this MVD strategy using multiple product lines, the annual model change, the extension of consumer credit, and lifestyle advertising. 29 These strategies shifted consumer perceptions of automobiles from commodities that offered simple transportation toward their being objects of fashion or status, allowing GM to sell more expensive, higher-margin automobiles. It also allowed carmakers to accelerate consumer repurchase rates, since obsolescence in style was accepted by consumers that would have contested functional obsolescence. The MVD approach allowed General Motors to quickly overtake all other car companies in terms of sales volume. For the next 50 years, the automobile industry was characterized by worldwide dominance of the big three U.S. carmakers, General Motors, Ford, and Chrysler. 30 Schumpeter 31 noted that by the 1940s, the Big Three controlled over 80% of the market, and, facilitated by this domination, tended to refrain from practices that would have been injurious to their profits, such as price competition. This resulted in the gradual increase in average profit margins as the industry enjoyed competitive equilibrium.